Hello everyone, hope you all are doing well. Welcome to Economist Desk. I am your host Shah. Today we are going to talk about global debt crisis. Governments worldwide are borrowing heavily to fund recovery, social programs and energy transitions. Yet amid fears of new debt crisis, one major emerging economy stands out for its stability, India. Today we will explore how India's macroeconomic strategy helps it manage debt, maintain growth and offer lessons for global resilience. As of 2025, global debt has crossed $315 trillion, roughly 336% of world GDP. This creates a serious debt overhang, a situation where high debt suppresses investment and slows growth. Rising global interest rates and strong US dollars have made debt servicing costlier, especially for developing nations with foreign currency loans. Countries like Egypt, Kenya, and Argentina have faced refinancing stress. In contrast, India's mix of domestic borrowing, prudent fiscal policy, and strong growth has limited its exposure to such global shocks. India's public debt to GDP ratio is around 83%, which might seem high, but what matters is debt sustainability, not just the number. If a country's nominal GDP growth rate exceeds its interest rate on debt, its debt ratio tends to stabilize or even decline over time. India fits that description today. Its external debt stands at about $736 billion or 19% of GDP, one of the lowest among major emerging markets. Importantly, more than 90% of government debt is denominated in Indian rupees, insulating it from exchange rate volatility. India's foreign exchange reserves, about $640 billion, provide a powerful cushion against capital outflows or currency pressure. India's resilience stems from a few macroeconomic strengths: high growth momentum. With real GDP growth of 6.7 to 6.9%, India's debt dynamics remains favorable. Rapid growth raises revenue, stabilizing the fiscal balance. Fiscal consolidation path. The government is reducing its fiscal deficits. The gap between expenditure and revenue from 5.1% to 4.4% of GDP next year. This is the key for long-term credibility and avoiding a crowding out effect where public borrowing limits credit available to the private sector. Monetary stability. The RBI has managed inflation near 4.7%, maintaining real interest rates conducive to growth while ensuring debt affordability. Deep domestic capital markets. India's bond market, worth over $2.5 trillion, allows the government to raise funds internally, reducing reliance on the foreign creditors. Healthy current account. Robust remittances over $125 billion annually and diversified exports helps keep the current account deficit manageable and strengthen the rupee. Still, risks remain. About 41% of external debt matures within a year, raising rollover risk if global liquidity tightens. Interest payments consume roughly 25% of government revenue, a fiscal rigidity that limits spending on infrastructure or welfare. The tax to GDP ratio, around 11%, remains low compared to peers, constraining fiscal space. And as India integrates further into global markets, shocks in energy prices or capital flows could pressure both inflation and in the current account. India's experience underlines a few timeless economic principles like borrow in your own currency to limit exchange rate risk, grow faster than you borrow, sustained growth is the best debt management tool, develop domestic financial depth so that fiscal needs don't depend excessively on foreign investors. Use counter-cyclical fiscal policy, consolidate during expansion, spend strategically during downturns. In essence, India demonstrates how structural reforms, fiscal discipline, and a vibrant domestic market can anchor debt sustainability. In a world burdened by debt and uncertainty, India's balanced approach offers an instructive case. Resilience is built through consistent policy, credible institution, and focus on fundamentals, not quick fixes. Thanks for watching. If you found this economic breakdown helpful, hit like, subscribe, and stay tuned for the more global insights.